So earlier in the year, I covered Asos and Boohoo stock, the UK fast fashion e-commerce retailers, and concluded that the stocks were most likely fairly valued or just a bit undervalued based off of my valuation model that I did. And there was no denying that the underlying performance of both companies has been admirable, but with headwinds such as competition, COVID uncertainty, increased shipping costs, looking likely to hit near-term profits, the stocks of both businesses have been falling. The company I'd like to focus on in this video, though, is Asos. And Asos, to me, is the more appealing out of the two, mainly because it's less, fast fashion or loud fashion than Boohoo is, but also because I like the people and the culture a little bit more, and the stock has been beaten down to a level that has made the potential buying opportunity quite compelling, even for someone who's not a fan of the fast fashion business. So starting with the stock, Asos has taken a severe tumble, in the past month or so, a couple of months or so, sorry. It's down 44% in the past 6 months, but more appalling is the 5-year return. It's down 34% in the past 5 years. That's something that makes you not want to look at the company straight away. And you might be thinking, why would you want to get involved with such a poor performer? And that would be a fair point. But the underlying results of the business were not the root cause of the stock's issues, or at least it seems that way. In reality, the underlying performance of the business has been very good. They've grown their revenues at a 20% compound annual growth rate, and pre-tax profit has grown even faster at around 29% compound annual growth rate. So that completely conflicts with the performance of the stock. So if we're looking for a root cause, it's most definitely been this multiple contraction. 58 times while the stock was growing at 15 to 20% probably wasn't a clever idea for investors to buy in the first place, and we've just seen that multiple trend down quite aggressively over the years, but it's got to a 5-year low, as of the most recent sell-off at around 15 times pre-tax profit. And I think ultimately the reason was, this was the poster child for e-commerce in the UK. It is obviously visibly a good business. It was stealing market share, but it just didn't live up to the multiple that was set on it. Now, they also have, a tendency to ignore what capital markets would want, or Wall Street, as the term goes. And they don't focus on short-term results, short-term margin pressures, things like that. Instead, they have a focus on doing the right thing for customers and are focused on the long-term sustainability of the business. For example, in the most recent sell-off, the root cause seemed to be the fact that they refused to increase prices, or said they were not going to increase prices of their products to reflect the higher shipping and freight costs that they are incurring. Therefore, they would be eating the potential gross profit contraction themselves. And this is something that obviously markets will hate, as it no doubt has an effect on this quarter's or this year's profit, but it's something that will increase the brand value in the eyes of the customers, and over the long term, something that should be seen as a sign of business and management quality, given the cost they're bearing isn't damaging, and it should add value to the franchise over the long term. So it's probably now a good time to recap on the business and its future prospects. Then after, we'll pair that with a valuation to see how compelling the stock has actually become in the recent sell-off. So to recap, Asos is an online fashion retailer, primarily targeting people in their 20s to early 30s. And they aim to offer customers the best online experience available through a curated selection of popular third-party brands and also Asos-owned brands through their online marketplace. They are a global business with 23 million annual active customers and sizable sales volumes, not just in the UK and Europe, but also the US and rest of the world. What's more, is they are a vertically integrated business in that they source a lot of their own products direct from suppliers or brands, and they facilitate the sale of those products on their own platform, and then handle everything from warehousing to fulfillment to express delivery to returns and customer service. And although this isn't uncommon in fast fashion businesses, it's Asos's value to customer first approach which makes it unique or stand out from the crowd. For example, their Amazon Prime-like annual subscription, which provides customers with free and fast delivery, usually next day delivery unless outside of the US and Europe, for just £9.95 per year. And there's also no minimum order required for that. So you could essentially purchase an item for, say, £7 to £10, and you'll have free next day delivery just because you have the subscription. And there's no doubt Asos lose money on this, just like Amazon do with Prime, but it attracts loyal and repeat customers to Asos and gives them a competitive edge versus their offline and even some online counterparts. And they also have a relentless focus on improving the price in which customers have to pay for fashion items to be purchased and, more importantly, delivered to their door. The latest example of this is their response to increased freight costs, which in most cases businesses are increasing the price of their goods to maintain the gross margin levels. But instead, they've found ways to use their scale advantages to leverage their supply chain with long-term contracts and new partnerships and things like that, which over time will stabilize margins and reduce their operating costs or cost of goods while still maintaining the lowest prices possible for customers. Now, they also invested into fulfillment and warehouse automation, which has visibly reduced their unit costs quite significantly whilst increasing the capacity at each fulfillment center. So in terms of results, this has actually led to an operating margin increase whilst delivering cheaper prices to the customers, which is something that definitely adds a significant long-term value to that business. Now, we've covered the business and its value proposition. Let's get an idea of the opportunity at hand. As with all investments, what matters is not the past, but the future. So, like I said, Asos is now a truly global business. It started in the UK, establishing itself as an e-commerce leader, fast fashion e-commerce leader, that began to export from the UK into other areas in Europe during around 2014 to 2016. And over the past few years, they've really been building the foundations necessary to become a truly global retailer. And actually, we've seen this start to bear fruit. They now have a very diversified revenue stream geographically and have built new fulfillment hubs in strategic areas, which can provide the full Asos service that's been available in the UK for some time and made it so successful. And they're lining up to have £6 billion of sales capacity by 2023 due to the plans for strategic growth in both established regions and new regions. This is against just a sales number of £3 billion currently, or just over £3 billion. But what's potentially going to drive this growth? After all, the only way you can grow as a business is either by your addressable market expanding, in other words, a demand or consumer behavior shift, or you're stealing market share from your competitors. And for Asos, although they have some advantages, I think they're going to be relying more on the former, which is addressable market expansion or consumer behavior shift. And an example of this, or prime example, is the acquisition of Topshop and Topman brands, who, like a lot of brick and mortar retail brands, found themselves in deep financial trouble during the COVID-19 pandemic and also after it as well, where consumer behavior had shifted more towards e-commerce than buying in store. And this was a brand that did over £1 billion in sales annually pre-pandemic, and Asos was actually able to acquire them for £265 million. So needless to say, if they can make that acquisition work, it would be a very high return on investment and provide some growth for the Asos platform. Additionally to this, another area of growth is the new strategic partnership or joint venture that they had announced with the US mega retailer Nordstrom. And this was more targeting growth in North America, and it led to Nordstrom acquiring a minority interest in Topshop and their brands, which will be selling Topshop, Topman, and Asos brand products on their multi-channel platform. So that's an area also of growth for Asos. I think they really are trying to drive growth in the US, and it probably will help having someone like Nordstrom on board to get the brand awareness out there. And there's still runway for Asos in their core areas at the moment, although it's a competitive landscape. They're still almost a tenth of the size of the likes of Zara and H&M in terms of units sold per annum. So there's definitely room for growth and to capture some market share off of the incumbents. And so now let's look at the valuation, like I said, to see how things are priced and what potential value there is for us as investors. I will admit, although it's a good business with good management culture, it's really the current price which makes this attractive rather than an attraction to the industry or a big opportunity in fast fashion or fashion in general. And if we look at the past valuations again, like I said, this is really the cheapest that Asos has gotten in the past decade or more, apart from a brief period in the COVID lockdown. You could have got it around 5 to 6 times EBITDA, would have been a great price to buy it. That was around £1 per share. It's now even at £3 per share after the sell-off, so even a triple since then. But apart from that anomaly, this today is the cheapest that you could have bought Asos over the past 10 years at 9.5 times forward EBITDA. And this is all whilst, the future prospects of the business are probably hotting up. Like I mentioned, you have a consumer behaviour trend that's developing favourably to Asos and others as well. But we've also got an expansion for Asos into other global markets that are growing quite quickly as well, with the same consumer-first strategy that made them successful in the UK and Europe. So at 9.5 times forward EBITDA, you'd argue that the stock is probably discounted for, say, a single-digit growth in the region of 7 to 10%, even if you had a high discount rate for the next few years. And this is all whilst the business is growing at 25% annually at the moment on a global basis. So growth is actually speeding up when we look at it year on year. It's gone from low to mid-teens to then 20% to around 25% this year. And when you have growth trends like that, it's unlikely that the momentum just shifts back down to zero straight away, or even 5 to 10%. Which would be a 75% fall off today's trend. It usually takes some time for that demand shift to fall off, but like I say, with the price today at around 9 times forward EBITDA, it's priced as if growth is just going to shift back down to the low single digits for the next few years, which is very unlikely to happen. And so looking at the valuation, it is starting to get attractive. I've put in here just for next year the guidance that they've essentially given, which is 20% growth, £3.9 billion in revenue, which I think they'll clear. Margins, I've actually put in, a margin, free cash flow margin contraction down to around 5.5%. It was at 10 or 11% this year, but they have said that, CapEx is going to be higher. And with the things that have happened with the freight costings and stuff like that, I think, free cash flow will go down. So it's a conservative, free cash flow forecast. But what matters really is this underlying growth up here. Like I said, the stock's probably discounted for single-digit growth at the moment with the multiple it has. This up here, this 5-year forecast is an 8% compound annual growth rate, while they're growing at 25% at the moment, and obviously have this geographical expansion on the card. So that gets us to roughly, 6 billion in revenue by 2025. Of course, we don't just want to be looking blindly at revenue. We want to look at the drivers of revenue, which will, for a company like this, will be annual active customers, an average order value, a number of orders and things like that. So we haven't looked at that. We're just, scanning over it at the moment. But essentially this 8% compound annual growth rate, which seems, unlikely to be that low, and with a terminal value of 15 times earnings, getting us to 5.2 billion in 2025, shows that the stock is undervalued by around 10% at a hurdle rate of return of 15%. So I'm discounting this back at 15%, which is quite a high opportunity cost. If we, took that down to 10%, then it shows we have over a 29% margin of safety on this stock at the moment on very conservative forecasts. If I, raise that PE to 20%, say that the market, starts to put more of a premium on Asos like it had done previously, we get out of this bearishness that we have for the moment, then the terminal value increases quite significantly. If we said growth was sustained at more of a 15% rate rather than 12%, because, like I said, it's unlikely it's just going to drop down to 12% in the next year and in 2023 as well. Then we get to a terminal value of around 7.2 billion for the company in 2025, which is more than a double from where we are today, even getting close to a triple then. So, I think the reality of this business is that they could quite easily outperform this. They are expecting to reach 6 billion in sales capacity by 2023. So indirectly, they're almost giving us guidance that that's what they're aiming for by 2023 or 2024. And there's a possibility that they get there. So, the stock is looking, more than undervalued. It's looking quite significantly undervalued on conservative forecasts. It's not necessarily a business or industry that I've historically wanted to jump into, but I'm definitely going to keep a closer eye on Asos. And for anyone interested already in Asos and was looking to buy at maybe levels above this and like the fast fashion industry, it's probably a good time to maybe start opening a position. But obviously, this is just based off of my hypothetical forecast. It's not investment advice, so take it as you will. For me, I'm going to keep a closer eye on Asos. You have got, all of you guys on the Patreon, you've got access to this valuation model for Asos and Boohoo as well, which we done previously. So I'll leave a link down below and you can have a play around with it yourself. That's going to be all for this video, guys. Just wanted to cover the ASOS story, what's happened at the moment, and look at why it's got so cheap, and whether it's a value trap or actually there is a good opportunity with this company. And I think there is a decent opportunity. So I'm going to keep an eye on it, probably do a bit more research, see what the next results look like. If it gets any cheaper as well, that could be even more compelling. But I'll let you know if I take any action on this. Let me know in the comments what you think of ASOS. I'd be interested to hear all of your guys' take on it. And yeah, I'll see you all in the next video. Good luck with your investments.